We hear anything new out of Sintra? You think that changes anything for you?
Well, I think the simple answer is no. I think it's just that markets are not really buying into what all of these major central bankers are really talking about. I think they are now shifting a bit of the momentum away from, look, we are moving past the peak in terms of inflation. But the other thing in terms of the dual mandate that most central banks need to cover is the labor market situation. And that is still very, very strong. And the second order effect of that is when you have a very strong labor market, it obviously drives also higher wages, and that spills over to prices to come back up again. So I think what we are seeing in our data is, yes, on a certain, from a certain perspective, yeah, inflation is lower, but monthly momentums are still well above seasonal averages. But on the other hand, it's really the employment numbers that are really a big struggle for central banks to really put themselves on a pause right now.
Can we at least attach, I don't know, a higher degree of confidence that, you know, the Fed is going to end before their counterparts in Europe will? And how do you trade that? Yeah,
so we do believe in that. I think when we actually look at our data, which we often use something called price stats, it's an online inflation metric that really drives daily inflation. What we see from our daily inflation is that the Eurozone inflation is still much, much higher in terms of a momentum versus the U.S. And that's really across the base of the Eurozone. We are looking at in Germany, in France, and Italy. It's actually quite a rare site where you actually see the entire region actually moving much higher. On the flip side of this story is we are starting to see the U.S. inflation story really cooling quite a bit. But as I mentioned before, it's not really just the inflation story that, Chair Powell needs to worry about. It's really also the employment stuff. But if it's just looking at the inflation front, I do see the ECB moving much more aggressively, obviously, versus the Fed. And that actually is encompassed in our views that we're still underweight many parts of the European bond space, and we actually want to take advantage of that against actually long some parts of the U.S. space, particularly the treasuries.
And it just brings up, this is probably what has been the most telegraphed recession that we've been calling for some time now. I mean, are we going to see it soon? I mean, when is it coming, or do you think we could actually avoid it altogether?
It's difficult to say, I think. I mean, if we look at what central banks want to do, is obviously they want to avoid the recession. They still want to balance things out. But I think what we heard from the talks overnight is very important, is that they want the market to buy what they're saying, and that is inflation is still high, employments are still relatively strong, and that is not what we consider as an area where they can pause. But unfortunately, that's not something the market is buying.
Do you see any recession signals across multi-assets right now? I mean, yield curve is one thing inverting.
Right.
Is that a clear indicator to you?
Well, that is, but I think when we actually look at a lot of other factors, like, earnings expectations, that's obviously been a driver in terms of year-to-date relative performance. That's still holding up relatively fine. So I think that not all earnings is actually doing well, but in terms of the aggregate, global equities, I think it's still okay. So I don't actually see recession being a big factor, and that's why none of them have actually talked about recession being a big risk, whereas they have continued to talk about potential back-to-back rate hikes.